Welcome back, everybody. Before we continue, I would like to remind you to visit today's resource page. It has a wealth of useful information that'll help you in your practices. Gentlemen, this has been a great conversation so far. We have so much more to cover, so I'm hoping that we will get through with the entire program today, but I'm sure we will. Let's talk about tax-free exchanges. And there's generally two kinds of tax-free exchanges, but we'll get into the personal sale of personal residences, which can be tax-free in a lot of cases. And we'll talk about that separately. But generally, when we're talking about tax-free exchanges of property, we tend to think of Code Section 12 or 1031, where we're taking business property and replacing with business property. Ruben, can you tell us how 1031 transaction works?
Absolutely. Well, let's cover some of the fundamentals, right? 1031s apply to only real estate property, and it's only for property that's held for investment of the production of income, meaning that you can't really do a 1031 exchange on your primary home. If you are a flipper and you're deemed as a dealer, then you can't really do that as a 1031. And then another thing that's very important is, let's say, for instance, that you want to do a 1031 exchange in a property, in a real estate property that's outside of the United States. That is not a like for like. So the property has to be within the United States. And generally, just to cover the general overview, you generally have 180 days from pretty much to do this whole entire thing. As generally, it would be nice if taxpayers would start everything on January 1st. That way they can finish everything in a timely manner. But they generally start, in a date where you may even have to file extensions to finish the whole entire process. But generally, it applies for real estate, and it's for business income producing property, or for use in a trade or business. The property does have to be in the U.S. And generally, you have 180 days to complete the whole entire transactions. And we're going to talk about how sometimes you do receive cash boot that may trigger a partial tax-free exchange.
I want to just kind of clarify a couple of things you said.
Yeah.
First of all, the 1031 exchange rules changed with the Tax Cuts and Jobs Act,
Mhm.
which made it only real property for real property. So that's where that what you're referring to there. Now, AJ, let's talk specifically um, on the 1031 rules. That timing. Let's start with timing. How does the timing work?
Well, first, let's talk about we got to exchange property. It can be improved property for unimproved property. It can be city property for farm property, even real estate with, for 30 plus year leases. But the replacement property has to be identified within 45 days. And I will also say, and some people will disagree with me, but I will also say in like kind exchange, right, we need a qualified intermediary. So it's probably one of the best ideas is to get an attorney involved. Because of our close relationship with our client, we're not the best qualified intermediary. So replacement property has to be identified within 45 days. And as Ruben said, property has to be received in 180 days, or as Ruben said, when the tax return, the due date, whichever is earlier. So sometimes we have to file an extension, but make sure we get that payment in with the extension in order to ensure that we get additional time.
The 45 days is the date of sale of the relinquished property, correct?
Correct.
And that 45 days can be prior to the sale as well as post the sale, correct?
Yes. Yes.
And then 180 days from the date of the sale to replace the property.
Correct.
Good. Just wanted to clarify that. And Ruben, in your example of the extension, because I've had more than one client do this, they did they sold the property in October, and they're replaced. They have up until, using math here, they have up until June.
Mhm.
That would be the 180 days to replace that property. No, actually, they have up
So
until,
so let me just jump in. So it's technically must be received by the earlier of the 180th day or the due date, including extensions.
okay.
Okay, and it's reported in Form 8824, since we want to make sure we mention forms. 8824, that's where we will report the like for like.
But we can't, because we don't know this is going to happen. I did have a client one year that they couldn't close in time. They were building replaced their house, they were replacing it with under construction. And because the occupancy permit could not get met the time of the 180 days, even though we put them on extension, and this is the purpose of the extension, just to give you a little background, folks, is that put them on extension, and because they couldn't close in time, they had to recognize a gain in the year they sold the property.